good afternoon, everyone. As Paul mentioned, I'm just going to spend a few minutes running through some tax residency and income sourcing issues. What we've noticed in more recent times, in particular post-COVID, there are a lot more remote working arrangements, and it has become a bit of a focus of the ATO. There's been some updates on the ATO interpretation of tax residency rules, as well as how they look to source income. So many organisations might think, well, why is the individual tax residency status of our employees important? It is important because it can impact an organisation's reporting obligations to the ATO and to the state revenue authorities. So depending on whether someone is a resident or a non-resident and the source of their income will impact whether they have pay-as-you-go reporting and withholding obligations, superannuation, FBT, as well as payroll tax. So just around what are the tax residency rules? So for those that aren't aware, the tax residency rules in Australia, there are 4 key tests. We have our primary test, which is the ordinarily resides test. And we have 3 statutory tests, which is the domicile test, the 183-day test, and the Commonwealth Super Fund test. So if the ATO believe that an individual is a resident under any one of those 4 tests, then that individual employee would be considered a tax resident of Australia. Now, what's important to note that is when an individual is a tax resident of Australia, they are taxed on income from worldwide sources. So depending on whether they're earning, regardless of whether they're earning income here in Australia or income abroad, that income is assessable here in Australia. For non-residents of Australia, though, they are only taxed on Australian sourced income. So understanding the source of their income becomes a really important factor. And as I mentioned earlier, we are seeing an increase in employees requesting from their employer to work remotely overseas. And a lot of these requests are being supported by organisations, which can be a really positive thing around supporting employees and whether they want to tag on work to an overseas holiday. But it's important that that organisation, before giving the tick of approval, understand how it will impact their obligations here in Australia, but also does this create obligations in that other location? So I've just put this really brief table together so you can see what are the differences between being a resident and a non-resident. If you are a resident, really, as I mentioned, you're taxed on worldwide income. All tax-free thresholds, tax offsets, levies, etc., still apply. Where you are a non-resident, then things do change quite significantly, and that can be for both the employee and the employer. So I mentioned at the start, this has become a bit of a focus for the ATO. For those that aren't aware, the ATO did recently consolidate 2 previous tax rulings that were dated back to the 1990s. They recently issued Taxation Ruling 2023-1, which really looked to consolidate those previous 2 rulings, but also provided a more modern interpretation of the residency rules. So this tax ruling provides 14 updated modern examples of typical scenarios that that come across the ATO's desk, and really provides an insight into the key factors that the ATO deem important when determining whether someone is a tax resident or whether they're a foreign tax resident. As I mentioned in one of those earlier slides, the primary test is that ordinarily resides test. And the ATO confirmed that there's been no changes in the tax residency rules, and it really does highlight that the key factors under the resides test still look at those key factors that are there on the slide towards the bottom of the slide. And they are period of physical presence in Australia, looking at the intention or the purpose of the presence in Australia. What's the individual's behaviour whilst they're in Australia? Are they just here on a holiday, or are they actually living and working here in Australia? It looks at where their family are located, where their business or employment ties are, etc. So whilst there are 14 more modern examples in this tax ruling, the devil is always in the detail. So it is always, whilst those examples provide some guidance, it is important to truly understand the facts and circumstances of the specific taxpayer, because certain facts can vary from person to person, and it can sometimes the residency status hinge on one or two key factors. So as I mentioned, the previous tax rulings on tax residency, or the two key ones, were TR 9817 and IT 2650. It's really important to note that this hasn't been a change in the residency rules. It is really just reframing the Commissioner's view. Many people might be aware that in the 2021 federal budget, the previous government did announce proposed changes to the residency rules with an introduction of a bright line test, which there was some additional consultation late last year from the current government. At this stage, we're yet to see whether the current government has any appetite to progress with those proposed changes, but we are still waiting to see or hear back on that consultation period late last year and what the current government are considering doing. So the first issue to consider is residency, and that's really important. The second is around source of income. And as I mentioned earlier, there can be significant implications for organisations where they approve an overseas remote working arrangement. We have seen a number of organisations approve overseas working arrangements, so whether that be short, medium, or long term, but not truly understand what the implications are here in Australia, but also are they creating some type of exposure in that other jurisdiction. So regardless of whether the individual remains a tax resident of Australia or becomes a non-resident, the consideration of are you creating a tax exposure in that other country needs to be considered. But also, if depending on the individual's residency status, do you have any ongoing obligations here? The last thing that we want to see is that the organisation continues reporting and withholding taxes here when in fact all the obligations sit in that other location. And that can be a bit of a process to request refunds from the tax officer that the money or the taxes due need to be paid to a foreign tax authority. So there has been a bit of a shift in the ATO's approach in determining how they source remuneration, which does put Australia a bit of a step out of the OECD norms. So the ATO's previous position really played a heavy importance over where was the individual physically performing those services. So even though they might have been performing services for an Australian organisation, being paid through the Australian payroll, if that individual was performing those services remotely in another country, the source of that income would likely be the country in which the employee was performing those services. And that really does align with the OECD approach and how a lot of other countries would look to source remuneration. And those principles were really taken from a case that dates back to the 1950s, known as the French case, which really brought out three main factors in determining source of income. It looks at where the employment contract took effect. It looks at where the activity is being performed, and also looks at where the payment for the work is being paid. So the location of the payroll and where the individual is being paid. So in line with the OECD model, this was typically the key factors, and most jurisdictions and the ATO historically put most importance on the location of the work being performed. So what's slightly concerning in more recent time is there has been one or two private binding rulings. So whilst these rulings are not binding on any other organisation and only on the individuals that have put in the application and the organisations, it does give us an insight into the ATO's shift in their view of how to source income. And what the ATO are looking to do is they're looking to put more emphasis on where the contract of employment took effect, but also as well as where the individual is being paid, and where's the economic benefit of those services that the employee is providing. So this is sort of goes against the OECD approach and could conflict with how other countries are sourcing income.
Sorry, Justin, just as a practical approach, just on that, would you be recommending people to make sure the contracts are signed overseas and that they pay into foreign bank accounts just to overcome that risk?
Yeah, where possible. We're seeing different types of overseas remote working arrangements. Some are with existing employees that are requesting to move overseas, whether it be as part of a holiday or whether they're originally from overseas and it's for family reasons. In those situations, it might need to be a variation of contract, at least to document that they're now performing their services in that other jurisdiction so that the contract doesn't state their place of work to be Australia. Certainly being for any new employees, whether it be a permanent overseas remote working role or a temporary, certainly documenting that their place of work is overseas. Being paid into an overseas bank account would be helpful. We appreciate there are some restrictions and limitations on payroll systems allowing that. So I think it's really to explore that with your payroll provider. And certainly if that is possible, that would help the situation. This slide really just takes us through a simple example. So an individual employed through an Australian business relocates overseas, becomes a non-resident, and works remotely, providing the same services that they were here when they were working here in Australia. So previous to that, the individual being a non-resident is only taxed on Australian sourced income, but under the ATO's previous approach, the employment income, because they were performing those services in another country, it would be that country's source of income. Therefore, no obligations here in Australia. With these private binding rulings in mind, assuming no variations or changes were made to that scenario, the risk is that the ATO would deem it Australian sourced income. That other country could deem it their sourced income, and we get a situation where both countries are deeming it their source of income, and we have a challenge around which country will claim a foreign tax credit. Now, a number of the double tax agreements that Australia has with some countries has a provision for this that we would need to work through to determine who gets or who should be claiming the foreign tax credit. But certainly in countries that we don't have a double tax agreement, this could create a situation of double tax. So I think the important takeaway here is for organisations that are getting requests, we appreciate many organisations are these days, really before approving that flexible working arrangement overseas, make sure you understand, is this creating tax exposure in that other location? But also what are going to be the ongoing obligations here in Australia? And that will start with residency, but then we'll quickly flow through to the source of that income.